Markets usually look calm right before expectations start doing the real damage. That is the situation Wall Street finds itself in heading into 2026. Stock indexes may still appear strong, headlines may still talk about innovation and resilience, but beneath the surface, investors are no longer chasing excitement. They are measuring risk. After a period marked by powerful rallies, aggressive narratives around artificial intelligence, and constant speculation about interest rates, Wall Street is shifting into a more demanding phase. In 2026, stocks will not move on hope alone. They will move on proof. At the center of that proof are three forces that now dominate nearly every serious market conversation: artificial intelligence, corporate earnings, and the Federal Reserve. These are not separate stories. They are tightly connected, and how they interact will shape whether markets remain supported or become far more volatile. Earnings remain the foundation of the stock market, and in 2026, Wall Street's expectations around earnings are more specific than they have been in years. Investors are no longer impressed by short-term beats driven by accounting adjustments or temporary cost cuts. They want to know whether profits are repeatable. The key question is not how companies performed last quarter, but whether their business models can produce steady results in a higher-cost, slower growth environment. One major issue investors are watching is the source of earnings growth. Over the last few years, many companies protected profits by reducing headcount, cutting discretionary spending, and slowing expansion. That strategy worked during uncertainty, but it cannot be repeated indefinitely. In 2026, Wall Street will reward companies that show revenue growth driven by real demand rather than financial engineering. Businesses that rely too heavily on cost control may find themselves running out of levers to pull. Margins are another major focus. Wage pressures may have stabilized, but they have not disappeared. Input costs, logistics expenses, and energy prices remain unpredictable. Investors will pay close attention to which companies can protect margins without continuously raising prices. Pricing power is becoming a key indicator of competitive strength. Firms that can maintain margins while keeping customers loyal will be treated very differently from those that depend on constant price increases to stay profitable. Guidance may matter more than actual results in 2026. Earnings calls will be analyzed for tone, confidence, and realism. Wall Street will listen closely to how executives describe demand trends, customer behavior, and future investments. Vague or overly cautious language can hurt stock prices even when reported numbers look solid. In a market driven by expectations, credibility matters as much as performance. Artificial intelligence is the second pillar shaping Wall Street's outlook, but the tone around AI has changed. Early enthusiasm pushed valuations higher based on potential alone. In 2026, AI is no longer judged as a concept, it is judged as a business outcome. The first AI question Wall Street is asking is simple: where is the revenue? Many companies have integrated AI features into products and services, but not all of them have found ways to monetize those features. Investors want to see whether AI increases customer spending, improves retention, or creates new pricing tiers. If AI becomes something customers expect without paying extra for, its impact on earnings may be far smaller than early optimism suggested. The second AI question is about efficiency. Early narratives claimed AI would dramatically reduce labor costs and expand margins. Reality has been more complicated. AI can boost productivity, but it also brings new expenses in computing power, infrastructure, security, and compliance. Wall Street will reward companies that use AI to improve output faster than costs rise. Businesses that shift expenses from payroll to massive cloud bills without improving profitability will face skepticism. Capital spending tied to AI is another critical issue. Building and running AI systems requires enormous investment in data centers, chips, power, and networking. Wall Street will closely monitor whether this spending produces long-term returns or pressures free cash flow. Investors are becoming more sensitive to capital discipline, especially in a world where interest rates are no longer near zero. Another signal Wall Street will watch is how widely AI benefits spread across the economy. So far, AI-driven gains have been concentrated among a small group of large technology companies. Investors will look for evidence that AI is improving productivity in sectors like healthcare, finance, manufacturing, logistics, and professional services. Broad adoption would support market stability. Narrow concentration increases the risk of overvaluation and sharp corrections. The third major force shaping Wall Street's thinking in 2026 is the Federal Reserve. While dramatic rate hikes or cuts may be less frequent, the Fed's influence remains enormous. Markets will respond not just to what the Fed does, but to why it does it. Wall Street generally reacts positively to rate cuts that reflect economic normalization. But rate cuts driven by fear of slowing growth or financial stress can hurt stocks. In 2026, investors will be focused on the Fed's motivation as much as its actions. Inflation trends will play a central role. If inflation continues to cool, the Fed has more flexibility. If inflation proves stubborn, policy may remain tighter than markets expect. Communication will matter as much as policy decisions. The Fed shapes expectations through its language, projections, and tone. Small changes in messaging can trigger large market reactions. Wall Street will closely analyze Fed statements, press conferences, and economic forecasts for signals about the future path of rates. Interest rates matter especially for growth and technology stocks, which depend heavily on future earnings. Even minor changes in rate expectations can significantly alter valuations. This is why AI-focused stocks are particularly sensitive to Fed signals. In 2026, the relationship between AI optimism and monetary policy will remain tightly linked. Beyond these three pillars, Wall Street will monitor supporting indicators. Consumer behavior remains critical. If consumers continue spending steadily, earnings can hold up. If spending weakens, revenue growth becomes harder across sectors. Employment trends also matter. A balanced labor market supports both demand and inflation control. Sharp shifts in either direction create risks. Valuations themselves are another source of tension. In many areas of the market, prices already reflect optimistic assumptions. When expectations are high, companies must deliver strong results simply to maintain current stock prices. This makes markets more sensitive to surprises, even in a stable economy. So what is Wall Street really watching for in 2026? It is watching whether AI can move beyond promise and consistently improve profits. It is watching whether earnings growth is driven by real demand rather than temporary discipline. And it is watching whether the Fed can guide the economy without unsettling markets. 2026 is unlikely to be defined by a single shock or breakthrough. Instead, it will be shaped by execution, credibility, and follow-through. For Wall Street, the question is not whether growth exists, but whether it is strong enough, broad enough, and durable enough to justify where markets stand today.